Hey, good morning, everyone. I wanted to get started on the presentation. I want to thank everybody for being here today. Everyone who signed up is pretty much a client. So I want to thank you also for your business. And what I'm going to do is if anybody has questions, everyone's in kind of listen only mode right now. If you could click on the chat box with the Q&A box, you can certainly type in questions if you have any along the way. I'll try to answer them along the way, or I'll definitely get to them at the end. And at the end, I will also just open it up and let everyone speak. And if you guys have any questions at all, this presentation is being recorded. And once it goes through my compliance avenues and channels, I'll email it out to everybody. I also have something I'm going to email out afterward that just a sheet summarizes everything we're going to talk about. One thing that we do have some new capabilities is just like the other webinar we did last month on Social Security, we can now do some Social Security calculations for anyone who's interested in that, just to see. It's amazing the difference between taking Social Security early or late. It could mean hundreds of thousands of dollars that I've seen for some folks. So important to take advantage of. We also now have capabilities just to take a look at your tax return to see if there might be some areas where you can save money. As many of you know, I am not a CPA. I try to familiarize myself with a lot of rules and a lot of taxes so I can give good advice. But next time when I do this presentation, I will also have a CPA on with me so they can, get into the nitty-gritty a little bit more. But we can do this analysis for you. And so if you want to take us up on that, just let me know. I'm happy to do that. The one thing that has been changed, and I think we're going to see a lot of changes this year with taxes, is I'm sure you guys have heard, you don't have to file taxes now until May 17th. And if last year's any indication of this year, it's going to take the IRS a long time to get to what they have because of COVID and everything else going on. So with that, I'm going to get started. So Albert Einstein said the hardest thing in the world to understand is the income tax. And I'll tell you, after World War II, the tax code was 8,200 pages, and now it's 74,608. So quite a lot of pages to kind of weed through. So what I'm going to talk about today is really 2021. So this year, tax rate brackets and changes, additional taxes on some high income that came in a couple years ago. And we'll just talk about some strategies and ideas for managing taxes. And again, we'll see what happens this year with taxes. Normally they would be going forward and not retroactive, but we'll have to see what happens retroactive back to this year. You guys all know me, everyone that's on the call right now. So the one thing I want to mention is I mean, a lot of you probably talked to Ashley Harlan. She helps me out as my kind of back office assistant with paperwork and things like that. In the next month to 2 months, I will have another associate joining me who will most likely be studying to be a certified financial planner. So more to come on that and things. So 2021, these are the tax brackets and the rates. Okay, so you'll see for single folks, up, let's see, most people in New Jersey are probably in the 24% bracket, if not higher. So you'll see what that is. So 86 to 164, and then all the way up. Changes from the last taxes we had, the highest bracket was actually at 39%, 39.5%, and we'll probably see something like that maybe later this year. We'll have to see what happens. So these are your brackets. A lot of people talk about effective tax rate. And so, for example, let's say you're married and you and your spouse make $200,000 a year. You'd be in a 24% bracket, but it goes, so you pay 10% on the first 19,900, 12%, et cetera. So your effective tax rate could be like 20% or something like that. Of course, there's Social Security taxes and other things that aren't included here. These are just really federal taxes. And then, no New Jersey, New York, et cetera, taxes are included in this either. The other tax you have are on long-term capital gains and qualified dividends. And these also could change, but these are pretty low. So as long as long-term capital gains are ones that last 300 gains you take after holding an investment for 365 days plus one. So as long, like if we buy something today, as long as we hold it till one day more than next year on the 24th, 25th, then we will be in good shape. So you'll see 0% tax up to $40,000, 80,000 joint, and 15% tax if you are individual 40,000, 80,000 joint, up to 445 single, 250 single, and 501 joint. Okay, so really nice tax advantage treatment. And for those of you that I work on taxable accounts for, I definitely look at trying to hold everything for long-term capital gains, because if you sell it within the year, you owe regular income tax on any gains in those investments. So people have different goals depending on the year and depending on what's going on. Now, a lot of us are just kind of W-2 income and we're kind of making the same amount of money every year, which is one thing. But if you have, you own a business, you might be selling a business or what have you, you may say, hey, I want to minimize my tax bill for 2021 because it is going to be a higher income year. I'm going to have lower taxes going forward. So you want to try to defer income or accelerate some deductions, okay? If you think 2021 might be a lower income year, especially for business owners, you may want to put more income into this year. So you could be in a higher tax bracket in future years and you want to accelerate the income and kind of postpone deductions. Something like this happened a couple of years ago with state and local income taxes where, now there's like a $10,000 cap, which for those of us that are in New Jersey, a lot of people's taxes on their houses are $10,000 or more. So that really was capped. So you're trying to get those taxes in the prior year to kind of save on the taxes when the deduction wasn't really applicable anymore. So this is just kind of shifting things to take advantage of tax. This also is good to think about for retirement. So a lot of times if people are going to retire, I might say, hey, take Social Security the year after you retire. So Social Security isn't as taxable. So there's just different things you can do to try to get out of paying as much in tax. So one thing, tough kids, when they see their first paycheck with the taxes, so teach your children about tax, eat 30% of their ice cream. So as you guys know, I have little things along the way because a lot of information will be here, just a little bit more fun. So all the stuff on the left here, I'm going to talk about. So minimizing tax bill for this year. So locating assets differently, maximizing retirement plan contributions if you're still working, health savings accounts, shifting income, managing losses and gains. And there are some deductions for long-term care insurance. In 2021, if you wanted to accelerate income, you could maybe shift 2022 income to 2021, maybe bonuses and things like that, if you can affect that. Accelerate long-term capital gains, maybe take them in this year, or short-term also. Increase carryable losses, push deductions out, move to a Roth IRA. We'll talk about that a little bit more later. Exercise incentive stock options, or take retirement plan distributions if you wanted to accelerate income. Okay, the first thing with planning is that if you're working, it's really great to be putting as much as you can into your retirement plan, especially for tax purposes. So as you know, contributions in reduce your taxable income in the year the contributions are made. And so for this year, 401k, you can put 19,500. You can put 26,000 if you're 50 or older. Thank God I hit that mark. Now I can put more into my 401k a couple years ago. IRA, 6,000, 7,000 at 50 or older. Simple IRA. And then if you're self-employed, you can put away up to $58,000 in this year. Okay, so really good limits, important to do. If you don't have earned income, obviously you wouldn't be able to do this, but anyone that does, you want to be maxing that out. Now, when we talk about, tax exempt, so this chart here shows municipal bonds. And as many of you know that I've chatted with, this is a strategy you tax-free yields. Now, the tax-free yields on municipal bonds really aren't 3% right now. For the ones that I've looked at, they're actually down in the 1 to 2%. So you're getting, definitely a better after-tax yield. However, it's something to consider, but municipal bonds and things like that are a little bit tricky right now. So I wanted to show how you can actually save some taxes, but there might be some risks involved with that. And everybody's going to be different, so we can chat about that individually, but this is a way to do it. And of course, any money you have in IRAs, 401k rollovers, it doesn't, this is just for taxable accounts. Also want to do low turnover strategies. So if you're turning a lot in your account, that could cause more taxes. And as a lot of you know that I do individual investing with, I do use a lot of exchange traded funds. And one of the reasons for that, especially in a taxable account, is I don't know if you've ever invested in a mutual fund 1 year and then you didn't sell it and you have this big tax bill. Mutual funds are required to distribute pretty much all their gains in that year that they take those gains. Exchange traded funds you still have to take capital gains and losses, and there are some income that you might get every year. However, if you buy a share of, let's say, GE, and let's say you buy it at 10 and it goes up to 13, if you sell it in an ETF, you can actually exchange the shares, and you might not necessarily have to take that capital gain. It's not necessarily pushed out to the shareholder. Okay, so the internal accounting and tax mechanisms of exchange traded funds are different than mutual funds. So I tend to use those, well, I use them way more often than mutual funds in tax sensitive accounts. And then there's also indexing. So you're buying the index, there's usually not a lot of turnover going on in the indexes. So over time, those tend to be good tax vehicles as well. So also you want to manage gains and losses. So of course, capital gains, short-term income, short-term capital gains, holdings, investments kept less than a year, increase income. Okay, so your losses can offset the gain. So a lot of you with taxable accounts, I'll call at the end of the year and say, okay, we just want to shift around a little bit. You know, let's sell this and either take $3,000 because you get that going forward for free, or we would offset losses and gains. This year, I guess good, there weren't a lot of losses to offset, but we did take some gains in accounts just so that you're just paying a little bit of tax at a time versus a big chunk. And that's really harvesting losses to offset the gains. And you can also recognize income. And again, we're looking at the asset holding periods. And then when you go to sell stocks, sometimes what you can also do is sell the highest in first out. So the shares that cost the most for you to buy, so they'll have the least capital gain, or the last in first out. And the way the markets have been, last in first out, last in is going to be the ones that are going to have the least amount of taxes as well. There's also first in first out if you want to take taxes. So there's lots of different ways to do this. And in the accounts, we can kind of designate how we want to sell shares at any point in time. Now, when you locate assets, you can do certain things to improve tax efficiency. So there's 3 really different types of investments. One, Roth IRAs and 529s. 529s are a little bit different because you can really only invest in mutual funds in a 529. With a Roth, you can really invest in anything. So because the Roth money is after tax and you never pay tax on it again, it's good to put things that might spin off more return or be a little bit more aggressive in the tax-free side. Tax deferred 401ks, IRAs, you're not going to pay any taxes on that until you take the money out. So again, it doesn't matter. You can have short-term capital gains in there, long-term capital gains. It does not matter. When you take that money out, it's going to be fully taxed at regular income tax rates. And then the taxable side is where you really want to be careful, because who wants to take a short-term capital gain if you can take a long-term capital gain, assuming the investments are still good and things like that. So in these taxable accounts, we're definitely using more exchange traded funds, some index funds, and really trying to focus on long-term capital gains. So the maximum tax you pay would be 20%. The other thing, if you have earned income, you can be putting money into health savings accounts. So your employer might have one, they may not, but you can set one up. It can reduce current year's taxable income. And there are different maximum deductible contributions you can make every year. Okay, so these are like 529s. It's after tax money that goes in, and any earnings that are used for medical purposes are tax-free. Okay, so as long as you use those, you don't have to pay tax on any of the earnings in these accounts. And these can also be invested in funds and different things as well. They don't have to just be in the money market. Okay, so here's intoxication. Intoxication is a euphoria at getting a tax refund, which lasts until you realize that it was your money to start with. So when we're doing our taxes, we kind of want to be even if we can at the end of the year. It is really way better to get money back than to be paying. And we want to set everybody up like that as much as possible. But this is definitely something that happens when you get your money back. Another way is to shift income to family members. So I actually have a client who has had Berkshire Hathaway, the B shares, for a really, really long time. And when she goes to sell them, it's like 80% or 90% of whatever sold is taxed. So, you know, she's been moving those to her grandkids, and which has been great. So she ends up shifting it. She's not going to pay tax on it. She's giving just a gift to her grandkids, and then eventually they'll pay on that. So that's one thing that you can do. There's also ways to transfer money, like appreciated stock from IRAs and other things into charities so that you don't have to pay tax on it, but that's a little bit different. And then if you own your own business, you could also put family members, if they're working for you, spouses, children, others, on your payroll. That'll kind of help to shift some of that tax liability. When you're rebalancing assets, instead of selling and taking the gains, you could put more money, invest more money in, so that you aren't really having to sell things when they're so high. So this is just another strategy to help with really short-term and long-term capital gains when you are rebalancing accounts. The thing is long-term care insurance. So of course, long-term care and needing long-term care are one of the biggest risks to anyone's portfolio as they get older. I mean, in New Jersey, it's $8,000 a month for nursing home care. And so basically, there are deductions for premiums. Okay, so everything's a little bit different and need to look into, but there is some tax benefits for long-term care insurance. So also there's different trusts and estates. So trusts pay 20% capital gains, so they don't get the 15% treatment at all. They also pay 37% on other investment income. And we'll talk about this net investment income tax. So they are subject to 3.8% on top of everything else. And then their brackets are also accelerated. Okay, so if they take $13,000 or more in income, it's taxed at a 37%. So those get pushed a little bit higher quicker. So this net investment income tax came about a couple years ago, and basically it's a 3.8% additional tax on investment income like capital gains, ordinary interest, dividends, and rental income. So if you're married filing jointly, $250,000, or if you're single, $200,000, and you'll see, I'll show you an example in a second of how it's actually calculated. So there are certain things that fall into that 3.8%. So these would fall into that tax of interest, dividends, capital gains, rental income, royalty income, non-qualified annuities, passive business activity, or alimony. They're not going to add the 3.8% if you go over the threshold for wages, unemployment, Social Security, non-passive business, self-employment income. So just the extra money that you're making from investments mostly, and alimony now. And so if we take a look at the example, Ben and Jane are married, they filed joint. So their income combined is $260,000. They've gotten capital gains and other income from rental properties of $50,000. So their modified adjusted gross income is $280,000. And the excess over $250,000 is $30,000. So they take the lesser of this net investment income or the amount over. And so they take $30,000 and you owe 3.8% on that $30,000 in tax. Okay, so it will be applicable for some folks, but just an extra tax to pay. So Mark Twain said, what's the difference between a taxidermist and a tax collector? The taxidermist takes only your skin. So we'll see, taxes seem to be going up from local level, and we'll see federally as well, potentially. So here's a Medicare hospital insurance tax. So this is almost 1%, a 0.9% Medicare hospital insurance tax. So again, it's the same. So 250 grand, married filing jointly 125, married filing separately, and single $200,000. And this is, so we take John and Rachel. John makes 180,000 and Rachel makes $150,000. So their combined wages are 330. and the joint 250. So income over the threshold is 80,000. So they owe this tax. So this doesn't really have to do with whether you have capital gains or not, or it would just all your income is taken into consideration for the tax that's owed on your wages. So what about deductions and exemptions? Well, to reduce your tax bill, unfortunately, some of them have been taken away. So we're going to talk about that. But so it is very difficult. Everyone wants to save money on taxes, and they do make it pretty difficult to do that. But you'll see, so standard deductions for your filing status, you get standard deduction for married 25,000 and then single 12,550. Okay, so you don't have to pay tax on the first 12,550 or 25,000 if you're married. So they did change this, so you can actually deduct, this was 50%, you can deduct charitable contributions of cash up to 60% of your adjusted gross income. You can deduct your home, so actually the deduction of home equity loans has been suspended. So you want to take a look at that. I didn't realize this until after the bill had gone through for a while, but home equity loans are not deductible interest anymore. Alimony payments are no longer deducted, and then moving expenses, those deductions are also eliminated. There are some exceptions for military and things like that, but in general, those are gone. So they used to be able to deduct for every taxpayer and dependent. You're not able to do that anymore. Oops, sorry. 2025, that phases out. And then there also were, there was also a limitation of itemized deductions that you could take. And this actually was also eliminated until 2025. So, you know, they've changed, they made it a little bit better, but it's a little bit easier to do taxes, but they've taken away the ability to make a lot of those deductions that we used to have. So this is Snoopy. Dear IRS, I would like to cancel my subscription. Please remove my mailing from my name from your mailing list. So unfortunately, we can't do this, the IRS, but I thought it was pretty funny. So if you're thinking about your taxes, you may want to just think, you know, are you getting your bonus or a raise? These all can kind of change where you're at. So did you sell or think about selling stocks or assets? Do you own assets that are worth less than you bought them? So maybe taking a loss. And, you know, capital losses can be carried forward. They need to be matched up with gains. So you may have some from before that you can actually carry forward, but it's, you know, versus the gains that you make in that year. Large expenses, have those come up? Have they been deductible or not? Are you supporting a family member, trustee or trust beneficiary? So as many of you know, the age to take requirement and distributions went from 70.5 to 72. So that'll cause more taxable income. Want to make sure maximizing employer sponsored contributions or RA contributions, and then self-employed or own a business. We're going to take a look at that and see if there's any other deductions. And then we can, you know, in years that maybe your income is less, we can, you know, also talk about Roth IRA conversions. The Roth IRA conversion is interesting because you just take like a traditional IRA and convert it to a Roth. If you think that the taxes are going to be a lot higher, however, you would owe a pretty good tax bill in that year, depending on how much you convert. So it's interesting to talk about that as well. Kind of appealing not to have to pay taxes again on those monies. So, you know, I am happy to, sometimes I sit down and we talk with CPAs and then have meetings with them, with you in the CPA to kind of go over the situation, and also estate planning and everything like that. So if I can help in any way, you know, please let me know. And, you know, we can help to make sure that we're giving you a full idea of what your finances are. This is just like a mid-year checklist. So just change in marital status, change of jobs, substantial increase or decrease in income, gains from sale of stocks or bonds, buy or sell a rental, start, acquire, sell businesses, buy or sell a home, retiring this year, 72 or older, refinance or take out a second mortgage, beneficiary of inheritance, have a child, taking advantage of tax advantaged retirement savings, any significant purchases, contributions to charities, estimated tax payments, make sure to keep up with those, prepared for this 3.8% surtax on this net investment income, Any unplanned withdrawals from IRAs can also, cause a lot in taxes. And then, it's hard to stay abreast of every new tax law change, but the experts you use will be good at helping with that. So Will Rogers said the only difference between death and tax is that death doesn't get worse every time Congress meets. So hopefully later this year, it won't be too bad. We'll see. This is a sheet that there's a lot of stuff here that it summarizes a lot of what I've gone over. So you can see the new law versus the old law, and then any comments on that. I'm going to email this out to you guys after this presentation, so you can just have like a cheat sheet if you want. These are those SALT deduction that a lot of us have. So deduction limited 10,000 for all state, local property and sales taxes. So, and it just stays like that. So we'll have to see, what happens. Mortgage interest used to be higher. Now it's $750,000, which is a lot of mortgage. Over that, you're not getting a deduction for the interest. And then there's all the standard deductions and the different brackets, the alternative minimum tax, which because of some of the phase outs isn't as good as the standard deduction. Different medical expenses, so 7.5% versus 10, which is good. So you can take a look at this, and there's two different pages on this, so you can take a look at. They did change things, so 529s can be used for private education under, not college level and other things. Okay, so I want to thank everybody for being on the webinar. In April, we're going to do retirement income, and then I'll do a market update. And then if anybody wants a tax analysis report, please let me know. And next time I do this presentation, and as I go forward, I will certainly have experts in those areas with me chatting on these different topics to provide some insight on what they're seeing, because it'd be great to see from an expert's point of view. Okay, so does anyone have, if anybody has questions, I'm going to open up for questions. If anybody wants to mute, unmute, just let me know, and we can, if anybody has questions, then we can handle those. I can handle those now.
Hey, Margaret.
Yeah.
It's Rich. How are you?
Hey, Rich. Good. How are you?
Good. You may not be able to answer this, but I'll just ask it anyway. So I have, all of my deductions for 403B money have been made for like the last 10 years. So it's a significant enough amount that I don't want to get taxed again if I leave New Jersey, because New Jersey doesn't allow you to deduct it when it comes out of your paycheck. Do you know how people avoid paying it if they leave the state of New Jersey?
Well, they can. So you you can roll it though. You mean you don't pay tax on it all at one time?
Well, what I'm saying is if I make withdrawals from the 403B, it's already been taxed in New Jersey, even though it was tax exempt at the federal level.
Yeah, New Jersey, the only state that taxes 403Bs.
That's right. Yeah.
Yeah. So my concern is that, let's say I live in Delaware and I'm withdrawing money to, for the purposes of just using it, I have to pay taxes on it at the federal level, but I shouldn't have to pay taxes again at the state level.
Yep.
But I don't know how that works, and you might not know either. I'm just asking.
Oh, I think we know how it works.
Yeah.
I think we suspect we know how it works.
Let me chat with, I have a couple, because let me check with a couple of folks I know, and I'll get back to you on that.
Okay, great.
I don't know the answer offhand. Do you know all the contributions that went into the 403Bs?
Yeah, from what I've been reading, you need to keep track of the type of money it is, and I have it through Fidelity. So Fidelity is tracking that stuff as to what was contributions and what was earnings on those contributions.
Okay. Yeah, let me check on that for you, Rich, and I'll get back to you.
Okay.
Thank you.
And then I had, hi Margaret, it's Mary. I had one other question on the home equity loan interest. So there's the new law and the slightly new Trump law. So I think based on what you were saying here, my understanding is that under the slightly new Trump law, you could continue to deduct home equity loan interest if it was used to buy a house or improve a house.
That's correct. Yeah. So you can't, so some people were taking money out to pay for college and things like that, and that's not deductible. So I would just keep receipts and show, what you have for that.
But then you had mentioned earlier that under the new law, it was, the ability to deduct was suspended. So in the new law, this year's law, have they completely suspended the ability to deduct home equity interest?
No, I think you're just gonna have to, the burden of proof will be on you. So if you deduct it, just make sure you keep all records for it. So it's not just like a kind of a free for all, you know, you could probably deduct it, but if you got audited, you're gonna need to show what's going on with it. Yeah. So I would just make sure you keep that. So some people take money to pay off credit, you know, people do lots of things with home equity lines of credit. And you just want to make sure as long as you can prove that, just keep all those records and everything.
Okay, great. Thanks.
Sure. Thank you. Anybody else? Everybody else good? Okay, well, thanks everybody very much. I'm going to forward this sheet so you have it. And then along the way, if you have any questions, let me know. And then if you want us to take a look at any tax returns and run it through this program we have, it potentially could find some areas that I'm happy to do that as well. Okay, so have a great day, everybody. And thanks a lot for your time and attention.
Thank you, Margaret.
Thank you. Thanks, everybody. Bye-bye.
Bye-bye. That was very helpful.